Billions are rushing into a new wave of hedge funds, making bold, high-conviction bets on artificial intelligence. And the speed of this shift is startling. Investors aren't just curious about AI anymore. They're betting big on the people who claim to understand where this technology is headed. But here's where it gets controversial. Some of the loudest voices attracting the most capital are brand new to professional investing. Consider this. A 23-year-old AI commentator known for a widely circulated manifesto that energized the tech community last year decided to move from talking about AI to trading on it. With no traditional portfolio management background, he raised capital for a hedge fund at a scale that many veteran managers struggle to achieve when they launch solo. That's not a small feat. It's a signal, and this is the part most people miss. Capital is flowing not just to track records, but to narratives, networks, and perceived insight into an unpredictable frontier. Why is this happening? In markets shaped by rapid technological change, investors often prize early differentiated thinking. AI touches everything, from chips and cloud infrastructure to cybersecurity, healthcare, and even legal tech. So fund managers who can frame where value could emerge next are drawing outsized attention. For some limited partners, the pitch is simple. If AI is the next platform shift, backing sharp thinkers early could pay off more than sticking strictly to conventional resumes. Still, there's a real tension here. On one side, fresh perspectives can spot opportunities incumbents overlook. On the other, inexperience can amplify risk, especially in crowded themes where momentum and hype can mask weak fundamentals. Seasoned managers will argue that disciplined risk controls, position sizing, and downside protection matter more than grand theses. New entrants might counter that the biggest returns often go to those willing to lean into paradigm shifts before consensus forms. For beginners trying to make sense of this, a hedge fund is an investment firm that can use a wide range of strategies, long and short positions, leverage, derivatives, to pursue absolute returns. When a fund focuses on AI-related bets, that might mean investing in semiconductor companies, data infrastructure providers, enterprise software adopting AI, or even shorting businesses likely to be disrupted by automation. For example, a fund might go long a chip designer benefiting from AI training demand, while shorting a legacy hardware firm losing market share. The thesis can be powerful, but timing, liquidity, and risk management are everything. Here's the twist that may spark debate. Is the market rewarding genuine insight or just charisma and virality? When an influencer-turned-investor raises more money out of the gate than many established managers, it challenges traditional views about what qualifies someone to run institutional capital. Some will see this as democratization of finance and a healthy bet on intellectual merit. Others will call it a speculative bubble in credibility, not just in stock prices. A balanced way to think about it, enthusiasm for AI is understandable. And some of these funds may deliver exceptional performance, but due diligence still matters. Investors should ask about the team's research process, portfolio construction, risk limits, scenario planning, and how they'll adapt if the AI investment cycle cools or regulations tighten. Practical indicators, like how a fund sizes positions, handles drawdowns, and validates models, can be more revealing than a compelling thesis alone. What do you think? Is this surge of capital into AI-themed hedge funds a smart reallocation toward the future, or a sign that the market is overvaluing narrative over experience? Would you back a brilliant newcomer with a strong thesis, or do you prefer a seasoned manager with a steadier hand? Share where you stand and why.